Hello everyone, welcome to the Mortgage Brothers Show. It is April 25th, it's a Monday. Let's get right into the interest rate update, where what we do Monday through Friday is go through the interest rates, where they're at today. We also today are going to be showing you kind of some data about what happens to home prices during recessions. Do they go down? Is it just a myth? Does it happen? Is it something we have to be really afraid of? Well, again, we're going to be going into that data, so stay with me. Before we get into the meat of this video, let's go through the quick disclaimer. This is for informational purposes only. This is not financial advice. Also, we are only licensed in the state of Arizona, so we can only specifically help borrowers who are getting a mortgage to purchase a house or refinance in Arizona. If you are new to this channel and you have not subscribed yet, if you are a buyer, right, and you're looking to purchase a house, or you're going to be selling a home, or you're going to be refinancing, or you're a real estate agent, this is a great channel to follow and subscribe to. All right, let's go right into the rates and where we see them today. We see them at 4.99% for the 30-year fixed conventional. We see the 15-year fixed conventional at 4.375%. The 5-year adjustable rate mortgage at 3.99%. The 30-year fixed FHA at 4.625%. The 30-year fixed VA loan at 4.875%. And then we have the loan assumptions below. So I like showing this to people because what we are going to see is from 3% down, 5, 10, 15, 20, 25, and 30. These are just giving borrowers an idea of what payments would look like and your down payment. So your payments, your monthly payments, and also like how much money you're going to be, bringing to the close if you were to purchase a $500,000 home, which is really close to our median the median home price here in Maricopa County in Arizona. You were to put 3% down, you would have a payment about $3,065. That estimates taxes and insurance in there too. You'd bring in about almost $21,000 to close. If you put 10% down, your payment's about $2,800, and your estimated cash to close is about almost $56,000. And you'll notice that there's that mortgage insurance right there. If you put 20% down, it goes to zero. But if you could put 15% down, it's lower than if you put 10%. And 10% is lower than if you put 5%. And so on. All right. So that's the payments there, going through that schedule. Big question for today, and we're going to be talking about this, I think, for the several months. And maybe the rest of this year or into next year, there's a lot of talk about recessions. Will a recession happen? And I will, as far as the likelihood of a recession, I'm going to be addressing that. I think there are a lot of signs in the market that are showing that a recession will happen, or at least it's probable that a recession will happen. But what will a recession do to house prices? I mean, most of us are coming off of, okay, we had a recession during COVID, but we also had, most of us who were working, and especially in the business in 2008, 9, and 10, we remember the Great Recession so well, and we remember those low home prices. How much depreciation we had in Phoenix. We had of just about 50% depreciation. So that's seared into the memories of everyone here who went through it, and across the country and the world. So let's look at the data and see what happens with home prices during recessions. And of course, we'll start with the last 45 years. This chart is from the St. Louis Fed, and we are seeing in the gray, see these gray columns? Those are the recession columns. Those are the periods of time that there was a recession. And what you'll notice, see this little skinny recession? That was the short recession of COVID. And this lasted it was technically only a recession for a couple months. But what you'll notice, for the last 45 years, we've seen 6 recessions, and the home prices in the U.S. have only decreased in one of those recessions. I had a lot, I really, when I was looking at this data, even just weeks ago, I was double checking. Every local market has a little bit different numbers. This is the national data. And so over the U.S., this is the home price index for the whole United States. Back in 1980, there was a recession, 1982, 1990 to 1991. We have the dot-com recession right here, all those 4 recessions all saw home prices generally increase or stay the same. It wasn't until that 2008 recession, the big great housing recession, that we saw this massive home price reduction. All right, and that's the only one that we saw home prices decrease. So that's the data, right? It's 1 out of 6, but will we repeat 2008? What is the difference between now and the 2008 recession? I think that's the big question we have to ask. Today's inventory is at an all-time low. This is the big difference between 2008 and today. In 2008, inventories of the home, so in 2008, inventories of homes were near an all-time high. Lots of inventory in 2008. Today, as we all know, you can't even find a house for sale. Inventories are so low. So 2008, inventories were really high. Right now, inventories are very low. And another difference is, look at rental properties. Lots of rental properties. I wasn't really sure. I had to look at the data. I was like, oh, I did not know this. I mean, I really forgot about that. In 2008, that's the end of 2008. That's when that recession really poured on. We had high vacancies, about 10% vacancies in rental properties. Today, we're at about 5.5%. So we're almost half of the vacancies. It's hard to find a rental property. So we have low inventories of home for sale, and we have very few homes that are actually available for rent. Also, due to the low inventory and rent, we have high rent prices. Okay, so we have high rent prices. Whereas back in 2008, prices were not, or at least the rent prices weren't as high. Okay, so in this next slide, we're going to see the setup to 2008. That, what was the primary cause for that recession, what was setting up for it, versus the setup today. Like, what is the setup today? If we're going to have a recession, what are the main factors? What are the main differences, really? Okay, so I've already discussed what is in 2008, the setup for inventory, the homes for sale. Very high inventory in 2008, but today, very low. We've already discussed that. Now, this is very interesting. A lot of people are not talking about this. That in 2008, if you were to ask all the homeowners in our country, what 30-year fixed rate do you have? A lot of them didn't even have a 30-year fix. They had like an adjustable rate mortgage. But if they did have a 30-year fix, the average was about 6.3%. All right, and then, so compare that to today. If you were to ask the average homeowner what their average 30-year fixed rate is, or what their 30-year fixed rate is, they'd say about 3%. So much lower mortgage payments today, or at least the interest payments are much lower. So homeowners today have low interest rates on their homes. If they were to sell their house and they were to go and rent it or something comparable, they'd be paying probably a lot higher rent, all right, than the mortgage payment they're in. Versus in 2008, you could sell your house and probably go rent your home for the same amount, or maybe even rent your home for a little bit less, right, than your mortgage payment. All right, so that's really important. That's an important part of this. Okay, so the setup in 2008 for underwriting standards were very low. Right? Income documentation there were a lot of programs, as many of you know who lived through that period. You've heard about all these alternative loans. You basically didn't need to document your income. So again, low underwriting standards. Today, underwriting standards are still very high. There was big corrections to prevent this from ever happening again. Now, debt ratios are still allowed to go pretty high, up to 50% in some cases of people's debts, or of their income. So people could argue, well, they're still high, or you can still get a lot of, the bank will still let you go high on your debt ratio. But the point is, it's much. These loans today are underwritten with a much higher standard than in 2008. Okay, so they're more likely to not go into default. And of course, just to remind everyone, the 2008 recession did start because of the housing recession. The housing mortgage crisis started. That was the catalyst for the recession. And that's unlike the other recessions were never started because of mortgage practices. This was the first time really in history that mortgages or homes had caused or was the catalyst for a recession. And also in 2008, what was also different is that corporations owned few homes. They weren't out there going and buying big portfolios of single-family residences to sell them. Today, there are lots of corporations that are buying up single-family residences. You've probably been hearing about them. Oh, all these cash offers out there. Those cash offers are coming from LLCs or subsidiaries of companies like BlackRock, which have like $13 trillion in assets and total funds, but they're getting into the rental real estate market, the single family home market. Also, home builders today. There are several home builders who are building subdivisions and not selling you the house. What they're doing is they're actually renting you the homes. There's subdivisions filled with a bunch of rentals. So my point in saying this is this part right here, corporations buying up inventory and builders who typically are adding new homes to inventory, they're not. So all these inventory problems, we're not going to get any inventory from builders, we're going to get less. We're going to have corporations buying up a lot of the inventory. Underwriting standards are high, and that people have very low interest rates right now, so they have very good low payments. So, will home prices fall if we have a recession? Of course, this video is for informational purposes only. This is just my opinion. And, it is impossible to predict what will happen. Based on the data and the facts, it just seems more probable that home prices will not fall in the next recession. And I know many of you will be like, well, how can that, are you sure? I'm not sure. I have no idea if it will actually happen, but I would bet house prices are not going to fall because the setup between today and in 2008 is so different, as I've just shown in the data. So keep in mind, for home prices to fall, this is the most important thing, there has to be a massive shift of home inventory put on the market for sale. All right, so if you see a bunch of homes going on the market for sale, okay, that could change things. But all the things that I've seen on this data is showing me that inventory is not going to increase. All right, inventory will probably stay low, so I don't see that happening, but it could if there's a massive shift in that. Also, rent values would have to dive lower and become appealing for homeowners who have lower rents, who see lower rents as a good trade away from their current low interest rates. All right, so if you have a great low fixed rate that we were talking about, so if you have a 3% interest rate right now on a 30-year fix, why would you want to trade? Why would you want to put your home on the market and trade it for a higher rent? Some people are doing that if they want to kind of, they're thinking they're going to trade this home, sell it, wait for the market to crash, and then buy in. That's risky, but that's what they're doing. A lot of people who are thinking of that strategy, that's what they want to happen. But they have to live somewhere, right? Everybody has to live somewhere. So if they're selling their home, they're likely going to be renting a home similar to theirs at a higher dollar amount than what their mortgage payment was. Last part of this presentation is just, please, a warning to everybody. Do not listen to the media. If you're listening to the media, you are getting information that is basically just clickbait. They're just trying to get you to watch their shows, watch their evening episodes, their morning episodes. They actually have very poor journalism standards when it comes to real estate, in my opinion. They're not showing you these data points, and they've been calling for home prices to fall since 2015. If borrowers were following the media's advice, it would have been an absolute disaster for homeowners. So please do your own research. Don't even take my word for it. Just do your own research. Be careful that, just don't make assumptions. Don't make assumptions just because it's something that you saw that what someone said will happen. Okay? Hope everyone has a good day. I'm going to be talking about the next data points tomorrow. Really through the rest of the week, we're going to be talking more recession stuff, home prices, home interest rates. So stay with us and subscribe. Hey guys, thanks for listening to the Mortgage Brothers podcast. Please let us know if you have any questions you'd like us to answer. You can email your questions to team@azmortgagebrothers.com and be sure to ask us for a free quote on your next mortgage. We'll be sure to give you personalized service and help you through the whole process. Signature Home Loans LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.